If you think $100 is too small to start investing, that one belief could quietly cost you tens of thousands of dollars. Most people don't fail at investing because they're broke. They fail because they never start. And in the next few minutes, I'll show you exactly how to invest your first $100 the smart way, even if you know absolutely nothing about the stock market. Let's be honest. When beginners hear the word investing, it sounds complicated. Stocks, ETFs, market crashes, risk. It feels overwhelming. So what do most people do? They wait. They tell themselves they'll start when they have more money, more knowledge, more confidence. But here's the truth. You don't build wealth by waiting to feel ready. You build wealth by starting small and learning along the way. And this is where it gets interesting. Your first $100 is not about making huge profits. It's about building the habit of investing. Because investing for beginners isn't about skill at the start. It's about behavior. So what should you actually do with $100? Let's simplify everything. When you invest, you are buying ownership in something that can grow over time. That's it. You're putting your money into assets instead of letting it sit still in a bank account losing value to inflation. Now, if you're a complete beginner, trying to pick individual stocks is risky and stressful. One company can go up, another can crash. Instead, there's a smarter approach. An ETF, which stands for Exchange Traded Fund. Think of it like this. Instead of buying one company, you buy a basket of hundreds of companies in a single investment. For example, an S&P 500 ETF gives you exposure to 500 of the largest companies in the US. When the overall market grows over time, your investment grows with it. You're not guessing. You're not gambling. You're investing in long-term economic growth. And historically, the market has trended upward over the long run. Now let's make this practical. Step 1. Open a low-cost brokerage account that offers fractional shares. Fractional shares allow you to invest small amounts like $100 without needing thousands. Step 2. Deposit your $100 and purchase a broad market ETF. Step 3, and this is the part most beginners struggle with: leave it alone. Seriously, don't check it every hour. Don't panic if it drops 3%. Don't celebrate if it rises 2%. Investing for beginners becomes powerful only when emotions are controlled. And here's something most people don't realize. Short-term movement doesn't matter nearly as much as long-term consistency. Let me show you why. Imagine two people. Alex invests $100 today and commits to investing $100 every month. Nothing fancy, just consistency. Sam waits 5 years because $100 isn't enough. Later, Sam tries to catch up by investing more each month. But because Alex started earlier, compound growth works longer in his favor. Time is the real multiplier. Not talent, not luck, time. And this is where compound interest quietly changes the game. At first, growth feels slow, almost boring. You might only see a few dollars gained. But over time, your returns start earning returns. That's when momentum builds. This is why starting early, even with a small amount, can be more powerful than investing a large amount later. Now you might be thinking, what if the market crashes right after I invest? Good question. If you're investing long-term, a market drop is not a disaster. It's a discount. If prices fall and you continue investing monthly, you're buying more shares at lower prices. Over decades, that can actually increase your overall returns. The real danger isn't market volatility. It's quitting. Another mistake beginners make is chasing fast money, trending stocks, viral crypto coins, get-rich-quick strategies. But wealth building rarely looks exciting. It looks boring. It looks consistent. It looks disciplined. And that's exactly why it works. Your first $100 won't change your life overnight. And you become someone who actually invests. That psychological shift is powerful. Because once you invest the first $100, the second $100 becomes easier. Then the third. Then automatic monthly contributions. This is how wealth habits are formed. Now here's your simple game plan. Open a brokerage account. Invest your first $100 into a broad market ETF. Set up automatic monthly investing. Ignore short-term noise. Stay consistent for years. That's it. No complicated strategies. No stock picking stress. No hype. Just time and discipline. And one day, years from now, you'll look at your portfolio and realize something powerful. It didn't grow because you were a genius. It grew because you started. If you're serious about building wealth, your first goal isn't making money fast. It's becoming consistent fast. Start small. Start smart. But most importantly, start now. And in the next video, we're going to break down how compound interest actually turns small investments into serious wealth and why most people underestimate it.